understand a whole life policy is something you should have for your whole life. So your agent relationship should be something that you think you can have for your whole life. So, make sure that whoever you do decide to go with, you feel comfortable that you are going to have that relationship for potentially your whole life.
Good afternoon, all. Steve Parisi here with IBC Global. I hope your day is off to a fantastic start. Today, we have a fun one for you. We've got someone that I've been trying to get on a podcast for years, and he finally said yes. So we are going to dive into a ton of detail. We've got my friend Max Pruger. Max, how are you today?
I am doing fantastic. Thanks, Steve. And I have been looking forward to doing this for nearly 10 years at this point. So it's my pleasure.
Check that out. Well, we will have some fun and we'll certainly get into some detail. Well, there's a lot that we want to cover around cash value life insurance, finance, infinite banking. But before we just dive into all of that, so people can get to know you a little bit, mind giving a little bit of your background with respect to the industry you're in and also your finance background, because I think people will like to hear that.
Sure, appreciate it. I'll go way, way back in the day. So I actually immigrated to America back in the 70s from a socialist slash communist country. We came here with my entire family without a dollar to our name. And of course, like good communists, my mom decided she wanted to run a business. So she started a little deli business. I started working, I think when I was around 11 or so. So from a financial perspective, just always been extremely conservative, saving. I saw my parents struggle. I worked a full-time job through high school, 2 full-time jobs in college at the same time, and graduated with a degree in computer science and math. Started in the IT world during the dot-com bubble and worked for a couple companies. In 2000-ish, I actually got out of IT and I bought a business with my brother. So it was a very large liquor store and bar. We did really well. And then in 2005, we ended up selling it. So that was kind of my first big liquidity event. I look back at those times and wish I had known about high cash value life insurance and IBC and so on, because I've done the math of the compounding on that, but I didn't know about it. Again, got back into IT. I've been running sales departments from a general manager, kind of executive vice president perspective for about 20 years. And then I just love finance on the side. So, my passion is whole life insurance, which I know is crazy because most people don't want to talk about that at all, but I do enjoy it.
You and I share that passion, my friend.
We do.
We'll get into more detail on that. So let me ask this. When was the first time you heard about whole life insurance prior to learning anything about the cash value?
So, I was familiar with life insurance. When I bought that large business, we had to get life insurance in order to offset the loan. So the bank required us to do that. That was a 10-year term policy. And then I had looked at whole life insurance, but never pulled the trigger on it until obviously I learned about IBC, and we can talk about that as well.
Yeah, got it. Okay, so let's transition into that infinite banking and cash value life insurance, because I know you had a small cash value life insurance product that was with a company that doesn't specialize in whole life insurance when you and I first connected. But let's transition into that. So specifically, infinite banking, the topic of cash value life insurance. When did you first stumble upon that and really started to learn about how the cash value works?
Sure. So I'm a big fan of the Austrian School of Economics. I follow Bob Murphy sort of religiously. And I remember him talking about it. It must have been 12, 13 years ago. And he talked about this incredible process of taking over the banking function in your life. So I followed him and then eventually Carlos Lara, and they had a podcast. So it was the Lara Murphy Report. And so when he started talking about it, when I run across something that I like, I've been told that I'm a voracious learner. So I bought every single book that I could think about. So obviously I read The Infinite Banking Concept, Building Your Warehouse of Wealth, How Privatized Banking Really Works, and probably about another half a dozen life insurance books. And when I read it, they say IBC is caught versus taught. It totally made sense to me, the entire concept immediately. And so that was kind of my first foray into understanding whole life and high cash value life insurance policies.
Got it. Got it. And you had done a pretty deep dive into looking into policies well before you and I connected, because we connected around 2017, I believe. And you had looked at a policy about 4 years before that. Correct me if I'm wrong.
Yes, that's right. once I started researching it, I actually went to the Nelson Nash Institute, and it was literally right when it started. I mean, it
Yeah.
was probably up for a couple weeks at that point, and I found a practitioner that was in my local area. I made an appointment to see him with my wife, and we went there. Very nice guy. He had an incredible financial background, but
Yeah.
to be honest, I was asking him questions about IVC, and he didn't seem to understand anything at all about it. Everything that he told me did not align with anything that I read in any of the books. And in fact, he showed me a policy illustration. Again, didn't really align with what I had read about. And at that time, it was actually around 2015, I had left the company that I was with for about 10 years to start a software startup company. And so I decided to put it on hold and focus on building that startup company. But over the next 3 to 4 years, I try to continue to research as much as possible.
Got it. Got it. Thanks for that. So, question on the piece as far as you saw an illustration that was presented from the agent, but it didn't really match up with what you had learned to that point, and that's what made you decide not to do it and then just focus on the startup you were working on. So, what were some of the details there? Because a lot of times where I see people fall into a trap is they research infinite banking, then they speak to an agent, the numbers look different from what they've seen in their research thus far, but they just trust the person they're working with and do it anyway, only to find out after the fact that they've lost a lot of money by doing that. So I'm just curious to hear about that a little bit more.
Yeah, so that's actually 100% accurate. He presented the policy, now again, back then, he used a company that we no longer use, or you guys no longer use. So to be clear, I'm not an agent. I don't sell policies. Again, he used a company that demutualized. So thank goodness, in retrospect, I ended up not going with that policy. But it was nowhere close to a high cash value policy. It was more actually of a traditional type of policy. I don't remember the exact details, but I think it wasn't even like a traditional 40% base, 60% PUA. It was, I think, closer to a 80% base, 20% PUA. Took somewhere between 12 to 15 years to break even. So I was looking at a pretty big premium. And I just did not want to give up that amount of cash at the beginning.
Got it. Got it. Thanks for that. That happens to a lot of people. There's some stories I won't share that I've shared them enough over the years. So you took a break for a moment just from the policy research, eventually circled back around. What did that process look like as you dug into cash value life insurance yet again?
Sure. So like I said, I continue to listen to Bob and Carlos Lara, listen to every single podcast that they had. Again, I continued to read books. And once again, the process just made sense. And while I was building out that software company, a knock on wood, we were doing pretty well. Revenue was increasing. We were hitting cash flow positivity. So as things started to slow down, I decided I wanted to revisit it again. So I just went back to the Nelson Nash Institute. I think I got 5 different agents. So I contacted 5 different agents. I asked them some questions. I pretty quickly narrowed it down to 2 different agents. And you know me, Steve, I ask about 1 million questions. I'm very analytical. And literally I emailed the 2 agents and I asked them some questions, and one of them, he knew what he was doing. He was very knowledgeable. And his reply to me was, I write more policies than anybody else. I don't have time to answer your questions. You can either move forward or find somebody else. And then the other person that I emailed said, sure, no problem. Not only is here an answer to your 25 questions that you're asking, but here is a spreadsheet with 15 tabs and a customized personal video, and sent that to me within like 15 minutes. And of course, that would be you, Steve. And so therefore, obviously, I think I made the right choice there.
Got it. Well, no, I appreciate that as well. Yeah, attention to detail. That's always a big thing of ours in the business. So let me ask about this. So you were doing research around infinite banking. That was back when I was I was a practitioner through the NNI at that time. Mm-hmm. But as the questions you were asking, from what I recall, some were on infinite banking, but the majority of them were all around the life insurance product itself and the mechanics of it, and really how to maximize the cash value and also make it flexible so it didn't feel like a burden from a premium commitment. Does that sound about right in terms of the detail on the product when you were digging into it, not so much the concept?
100% accurate. I'm pretty anal, especially when it comes to my money. So I want to know everything that I can before I commit my cash to anything. In addition to what I do as my normal day-to-day job, I also own a lot of real estate. And so to get into some specifics, at that time, I had some property. I had a $40,000 property tax bill that was due every single year. And what I would historically do is I would save money in just a money market account, which, back then I think we're paying like 1.5, 2%.
Yep.
And every year we would get to January, I would pull out that cash, I would pay the property taxes, and then I would start the very next day saving for those property tax bills again. So I had a specific need. I read through all of the examples of equipment financing and how you put the money into the policy first. Every dollar that flows through is yours and earns compound interest until the day you die. And so that made a lot of sense. And I had a practical use for that policy.
Got it. I remember that too, specifically when you funded that policy and then getting the money out quickly just with the insurance company. We were running into some issues and they ended up saying, well, we can do it overnight via UPS before things were all automated via direct deposit back then. But from what I recall, it did work out.
Yeah, it worked out great. In fact, most people say it takes something like 2 weeks in order to take your first loan. Again, if I remember correctly, and this is thanks to you and your office, I think I actually got the money within like 4 days.
It was quick.
Yeah, it was very, very quick.
I remember that. And that's when our team was not that large. So I remember Stephanie working on it, her asking me about that loan, and then just going over exactly what to do, what the customer service rep said. And then, yeah, it worked out. It always works out as long as, one's on top of it and you get in touch with the right people. I'm talking about the agency side with the insurance company. But yeah, that one was quick. And typically they are quick too, like 2 to 3 days is usually the turnaround time with loans nowadays, sometimes quicker. So on the policy side of things, like when you're looking at a whole life insurance policy, whether you want to use it for infinite banking or just cash accumulation, what's typically your process? Because I know a lot of times when someone is looking into whole life insurance for themselves, they'll often ask you just for some tips or advice in terms of what you do. So what are some things typically that you would advise someone in terms of, hey, make sure you don't do this, which would be similar to your process?
I believe as Thomas Sowell said, there are no solutions, there are only trade-offs. I would love to take the best of several different companies and combine them all into one. So part of it is just understanding what the buyer is specifically looking for. So most of my policies, full disclosure, they're either Mass or Guardian. Guardian is extremely flexible. My first 2 policies were actually with Guardian. And by the way, you had pointed out, I did have a IUL. In fact, my wife had an IUL that she had started when she was 18, and we 1035 exchanged that into one of the whole life policies. Again, I like Guardian because of the flexibility. And then most recently, my most recent policies have been with Mass. I like Mass because I can pay the full premium for 40, 80 plus years. So my kids' policies are Mass policies. But again, at the end of the day, I look for what exactly it is what you provide, Steve, which is high cash value policies, 1090s, break even in somewhere between 4 to 6 years. So like pre-7702, I think it was 3 to 4 years. Now they're about 4 to 6 years. I'm a techie, so I like technology. Ideally, I love you, Steve. I love your office, but I prefer not to talk to anybody if I don't have to. So I just want to go online. I want to request my loans. I want to be able to track the status. I want to pay back my loans, pay my premiums, and so on with as little human interaction as possible. So, we're talking about a life insurance industry. They've been around for 200 some odd years. So some of these companies are not as technologically savvy as others.
Yeah, they can move slow to say the least. Now, thanks for that overview. Yeah, typically everyone we speak with, when they're interested in using the policy, that part's easy, where you're just explaining how loans work, borrow, repay, cash values restored. The big coaching piece this is where we spend the majority of our time from an education standpoint, is showing one how to get as much cash value as possible upfront, long-term, and also make it flexible. And what that means is not being obligated to pay a big premium every year. So we want to talk about that a little bit. You mentioned Guardian with the flexibility, just in terms of how you've been able to fund the policy, where you don't have to write a check for the full premium every year because you've got insurance, which everybody thinks fixed premium, but then you take this product that's designed for cash accumulation. So the buyer views it as a savings asset or place they can put money in, but they don't want to have to make a one-time per year payment. They want to be able to add money like they would anything else, like a bank account.
Yeah, so Guardian, again, that's my favorite part about Guardian is it's extremely flexible. Just going back to my real world, how I started. I mentioned I had a $40,000 tax bill. I believe my first premium, and I don't believe it, my first premium was 100K, and I had saved about $60,000. So what I did was I immediately funded the policy with 60 grand. Within 3 to 4 days, I took out a loan for $40,000, and then I spent the next several months paying the full premium up to $100,000. I then spent several months more paying off that loan. And then by December, when December rolled around, I had about another $70,000, $80,000 at that point in the account. So I took that money out, paid the premium, paid
Yeah.
the property taxes, and so on. And I just kind of repeated that process. So that's what made Guardian very flexible. Now, my mass
Nice.
policies, unfortunately, you do have to pay those the full premium annually. I had a liquidity event. I started a new mass policy with pretty good, general, I'd say relatively good size premium. And I made 3 payments of that. But about 2 years ago, I didn't have the full premium available. So I was able to make a smaller payment. And then this year, I actually was able to catch up on some of that payment as well. So
Back.
not quite as flexible as Guardian, but it's working as designed.
Yeah, it still works, especially if one's comfortable with that one-time per year payment adjustment, which is nice. What are some of the things you've used your policies for? So you mentioned the property tax when you started your first one. You're also big into real estate. You want to share a little bit how you've used it for real estate opportunities?
Sure. And before I get into that, I mean, I've used it for like literally just bought a car for my son. It was a used car. Interest rates for used vehicles, even with great credit, were about 10%. So I
No.
said, that's not going to happen. So I used a policy loan and purchased a car for him. So now he's got his little part-time job. He's paying for my daughter's in college. So we've used it for college tuition. And then primarily I do use it for real estate. So I use this one example. I'm in a IBC group on Facebook. So we'll talk about that, I guess, towards the end. But I use this as an example. And just to be clear, I mean, this is definitely what I call a home run. This is not going to be your average example, but it's real. I like data and I like reality. So I talk about it. But probably about 6, 7 years ago, my brother and I had an opportunity to purchase a shopping center, and they listed it for roughly $2 million, but they wanted a fast close. So that's what their ideal situation was. We offered 1.6 million, but we were able to close within 30 days because I knew that I had the cash value available, that if necessary, I could just pull out a loan, pay for it all in cash, and then refi after the fact. So we offered a 30-day close. They had higher offers, but they accepted ours because we were able to close faster than anybody else. Turns out we have a pretty good relationship with the local bank, so we did get it financed. And in order to get it financed, we had to bring in 25%, which was $400,000. So policy loans in the bank within 2-3 days. We were able to close within 30 days. And it was the center itself was in a great location. It was extremely neglected, so it absolutely needed a lot of TLC. It was only about 40% leased at that point, so it wasn't even positively cash flowing based off of the loans. So for the next 6 months, I didn't spend a single dollar repaying the loan. We did a lot of upkeep on the property. We painted it. We ended up leasing it fully, so we got it 100% leased. And 6 months later, we had an offer to sell it for $3 million. Wow. So if you do the math on that, even if you say it's a year later, I believe that's a 650% return. So, I'm on Facebook and you hear all the gurus and they're talking about getting 10 to 12% on 6% of your money or whatever it is. I don't even worry about those things. So it's a 650% return on that 400,000. But if you think about it, I didn't use my 400,000. The insurance company actually gave me a line of credit. In fact, actually at that time, because interest rates were so low, I had actually assigned my cash value to a third-party lender. Yep. So I was borrowing at 3%. So 3% $400,000 is $12,000 a year or $1,000 a month. So again, even if you say it was not for 6 months, but a year at $12,000, my return was 24,900% annual return on that investment. So to be clear, I still have the shopping center. It's valued significantly more today than what it was 7-8 years ago. But that's what you can do when you have control and flexibility and access to cash. There's no way that I would have ever been able to purchase that center if I didn't have access to capital.
Yeah, no, thanks for that. And let me talk through this with you because that example is phenomenal. And what I might talk about with a real estate investor is, well, why would I not just keep money in the bank? Like, what's the difference there? And this is someone who's relatively new to cash value life insurance.
So one, you have to understand the business that the bank is in. The bank is not in the
Yeah.
business of giving loans. It is in the business of collecting money. If a bank could never give a loan and still make lots of money, that's what they would do. So, it's not good, it's not bad, but the bank is not your friend. So I know a lot of real estate investors that were doing extremely well that got completely wiped out in 2008 because they had, at that time, cash flow. Their LTVs on their properties were 60, 70%. And then the market crashed and all of those lines of credits that they had, the mortgages were called. So a lot of, people assume that because over the last 15 years, real estate has just gone up, that it just automatically goes up. And that's obviously, that is not the case. So again, it's control. When the money is in the policy, I have a contractual right to loan against that policy anytime I want. And the insurance company does not have a collections department. I've got, let's just say, 7 figures in outstanding loans today. I've literally haven't paid back a policy in about 2 years. I do pay the interest annually, but as far as the loan itself goes, it's been about 2 years since I've made a principal payment on the loan. Nobody calls me and says, when are you going to pay it? When I ask for money, they ask me 2 questions. How much? And do you want direct deposit or a check? And that's it.
Yeah.
So, it's the concept of control. When you're in real estate, business people, real estate investors, they understand that control is one of the most important things that they can have with their money.
Yeah, a lot less stress too, because you're not dealing with a bank or a lending institution that affects your credit, or you've got to deal with that loan and pay it off. I mean, from a discipline standpoint, I know you like to pay loans. Most people do on life insurance policies, pay them off, but you don't have to deal with any third party coming in and saying, hey, you have to pay this. In many cases, when you look at people using these policies for retirement income, how you get it out tax-free is by taking loans and never paying them back. I just use that to illustrate the fact that you've got that flexibility there. And
And
then,
it's opportunity cost. I pay 5.5%. If I can
yeah,
have my money earn more than 5.5%, then it's better that it's out there and earning me more than 5.5% today.
yeah, you've got that. And plus, I mean, your money's still compounding. The amount that's outstanding via loans is still working for you as well, which is going to offset that cost. And depending on the timing and how old the policy is, the net cost might be 1 or 2%, or it could be close to a wash or slightly in your favor. That's my favorite thing to go over whenever we're analyzing using a policy for a deal. What's my net growth in the policy? What's my net cost to borrow? And if I come out ahead just using the policy, then the real estate just becomes that much sweeter because that's the return that I have control over, but I want to use the policy the right way. So it's a win-win in that respect.
Yeah, and I track my policies and my
Yeah,
loans
you do.
pretty significantly, and it's about a half to 3/4% carrying cost.
Yeah,
And then again, but I have lots and lots of death benefit as well,
yeah.
and all the other benefits that we talk about. So, like you always say, yeah, it's safe, liquid, tax-free, and it's continuing to compound on itself.
Those are the 3 core benefits I like to talk about. So let's talk a little bit about your Facebook group, which you started for what reason?
So I was frustrated. Like I said, I'm
Yeah,
pretty anal. I like to learn as much as possible. And to be completely direct, I started my policies with you. So I started my first 2 policies with you at the same time. And then I continued to learn and listen to podcasts and so on. And I started hearing a lot of things about how 1090 policies are going to MEC, how they're unsafe, and so on. And so, again, to be honest, at a certain point, I was thinking, do I have buyer's remorse here? Did I do the wrong thing? What am I supposed to do? And I had just gotten started. I was literally, I think, 6, 7 months into my policies. And to be clear, they're working exactly as described and expected, and so on. So I reached out to another agent, well-known, I won't go into names, and talk to them. And of course, again, I've been in sales for 20 years. I understand all the sales tactics out there. I like to talk about FUD a lot. So, from a sales perspective, you create fear, uncertainty, and doubt. So So there's a lot of fear in the industry about, oh, this policy is going to mech. You're not going to be able to pay into it for a long period of time. The illustration is wrong the moment that it's printed, and so on. And that's really out there just to spread potential fear of a future event. So I wanted to talk to users, and I couldn't find any. I mean, I was on Facebook, I went on Reddit, and I couldn't really find it. So being the person that I am, I decided to start a group on Facebook for users. It's called IBC Users Group. When I first started, it was only for users, but we've grown. We've got about 5,500 members today. I opened it up to agents probably about 3-4 years ago. I have one rule: you cannot solicit. So agents are welcome to be in the group. They can add value. They can answer questions. But anybody who goes out and reaches out directly to somebody without their permission or starts soliciting in the group, I kind of rule it with a pretty heavy hand. So I'll kick them out pretty quickly.
So I see a lot of communication occur in the group, just often between agents, sometimes users, on those topics you mentioned in terms of policy design, whether it's a 1090 or whatever design it is, being able to pay forever, it's going to mech. Let's hit on that a little bit, because there are a couple of things I want to add too. So what do you hear most frequently just around the topic of that 1090 design from users, if you can think of any? Yeah.
To be clear, I have no horse in this race. If you want to buy a 100% base policy, more power to you. What frustrates me is all the misinformation that is out there. So obviously, again, I put my money where my mouth is. Most of my policies are 1090. I actually have a more traditional 40/60, and I'm happy to talk about that. In fact, I'll talk about that right now. So I started it same time, same premium. I got my 1090 from you, Steve, and then I got a 40/60 from a well-known Nelson Nash agent. And I post the results every single year. So I'm 7 years into those policies. Actually, the next update will be in the next 3 to 4 months, and I post that in the group. And like I said, people talk about FUD, and there's I don't know if you know who Michael Malice is, but he's a big libertarian. He likes to talk about, he's got a statement that says, a comment is factual but not truthful. So it is factually accurate that the moment an illustration is printed, it's no longer accurate because things change. So, but while that's factual, it's not truthful, because yes, even though it changes, again, I post the results on those policies. I've done it every single year. You can go back and look at the history. Both of those policies are within 99.99% of original illustrations. Now, the 1090 is significantly outpacing the 40/60. And it's not only did it have 50% more cash value day one, it is pulling away. So that policy is designed to be able to pay the full premium for 40 years. So we will see. I don't know. I can't predict the future, but Mass, I get my in-force illustration every year. Mass checks it so that it doesn't mech for the guaranteed value, the non-guaranteed value, and the midpoint value. And again, so according to the illustration, every year it is shown not to mech at any point in time.
Yeah, and one thing too, just on that comment, because I've heard that before. The moment you hit print, the illustration is no longer valid. So I would push back on someone who said that, and the reason why is illustrations are valid from year to year. Meaning, if I run an illustration today based on the current dividend rate today, and I fund the policy exactly as illustrated, so the illustrations assume that I make the full payment all up front the day I start that policy or within the first month. On that anniversary date, my cash value on that illustration should be exactly what I see on my annual statement. And then the next year, I want to run a new in-force illustration based on the updated dividend rate, and if the company made any adjustments to their mortality charges and other things that came with the policy. But illustrations, like in my experience before I started my own business, working at the executive benefits firm, they've been always valid year to year. Where someone might believe that things can change a bit is, take Guardian, for example, where you can add PUAs at your discretion. If I look at an illustration and it shows me if I put 100 grand in at the end of the first policy year, I'm going to have $88,000 in cash value. That illustration assumes I pay the full 100 grand up front. If I throw PUAs in sporadically over the course of the year, what insurance companies do is apply a prorated dividend based on the month that those PUA deposits are made, which would then result in less cash value at the end of the year. So there's small details that could impact the actual reason why that cash value is different than what's illustrated. Could also have the loan feature if it's direct recognition, whether they raise the dividend or reduce the dividend on borrowed funds. But you've got other elements there. But if somebody is like you, take with your mass policy, for example, and very consistent, boom, 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 year in and year out, unless you backdate the policy or something like that, you will see a case where that cash value should always match the annual statement. And if I see that that's not the case, that's where I'll go to the insurance company and say, hey, you guys messed up, and they correct it. At least that's always been my experience on that piece.
Yep. Yeah.
Yeah.
And again, just to be clear,
Yeah.
you're talking about a marginal difference.
Yeah. I know.
For a while, actually, my policies were slightly lagging behind. They're about
Yep.
1% behind. And that's because when I got the policies, the interest rates were higher. They came down for a little period. And now over the last 2, 3 years, they're going back up. So literally I went 98% of what was originally illustrated. And now it's gone back to 99.99% of what's originally illustrated. And my expectation is that this year they'll actually be over what was originally illustrated. So again, my point being is, is it 1%? Is it 2%? Is it factually accurate that it's not going to be exactly the same? Of course, because interest rates will change and therefore dividend rates will change and so on. But is it really truthful to allude to the fact that these things are they're not 10% off or 40% off or 50% off? So that's kind of that misinformation that's out in the market. And to go back to your original question, so you asked, what do users think? I have yet to find a single user in my group or anywhere else that is unhappy with their 1090 policy. It's working as expected. They're taking loans and so on. To be honest, it's really just the agents who seem to have a problem with them.
Yeah, no, I mean, I've heard that for years from people that I used to work for, and then obviously from my peers all the time. Like, what it often boils down to is the agent compensation, and that's not to say, hey, they're just motivated to sell and make more money. Just when you look at a policy, even if you are not licensed, the more cash value a consumer has up front, meaning with a lower base premium, because that doesn't show up in cash value in the first year, PUAs do, the more cash value the consumer has, the less compensation the agent will make. That is just how it works. And you can't control that based on how the insurance companies pay out commissions. So the higher the base premium, the higher the compensation is. So the challenge I have with recommending a higher base premium to anyone is, one, I have seen zero proof that they actually deliver stronger cash values to consumers long term. Yeah, a hypothetical illustration might show that 30 or 40 years down the road, the dividend could be greater, which finally nudges you higher than what you would have with a low base premium. But I've seen the opposite occur when I track actual results. I've seen lower cash values delivered on policies with higher base premiums. So I'm like, okay, that's a big risk in my mind to go advise someone to go with a higher base premium, hoping that they'll have more long term. Because if they don't, which I've seen happen with higher base premium policies, they lose, but then I still won because I earned a higher commission there. And the problem, and maybe this is me just in my own head, is that's a huge reputational risk from a long-term perspective, because if that's you, you'll look at it and say, okay, like I took a hit up front with the expectation to have more long-term. It didn't happen. You made more money. Like, that's not fair. Like, why didn't you just put me in the option that guaranteed me more from the beginning and guaranteed me more long-term, which is the low premium, low commission option?
I want to be clear. I've been in sales for 20 years. I have no problem with sales folks. I was in direct sales. I ran North America sales. I've run worldwide sales. I've run sales teams for 20 some odd years. I have zero problem with commission. I think if somebody provides a valuable service, they should be compensated accordingly. So once again, if somebody wants to buy a 100% base policy and the agent gets that commission, more power to that agent. What I don't like is misinformation. And this goes back to the factual but truthful. So you also get comments like, there's no deals in life insurance. And I 100% believe that. Again, there's trade-offs. The problem with that is that while it's factually accurate, it's not very truthful, because in a life insurance transaction, there are 3 parties involved. So don't include, the third party. So there's the buyer, the owner of the policy, there is the insurance company, and then there's an agent. And so when you make that premium payment, so I'll use 100 grand as an example, if you do 1090, then roughly 10% goes to the base, and then 90% of it goes to the PUA, which is effectively cash value. So the insurance company takes that $100,000 and says, okay, I'm going to pay commission primarily on the base. So the agent, again, I know it's a little bit more complicated, this, but just at a high level,
You got it, though.
the agent gets $10,000, and then the insurance company gets $90,000. And the insurance company's business is very easy. They take in premium, they put it to work, and then they pay you a return and a death benefit at the end. So at the end of the day, you take that exact same example, and it's let's just say 40-60. So $40,000 of that goes to base, $60,000 goes to cash. The insurance company takes that $40,000 and gives it to the agent, says, thank you very much. You did a great job. Here's your $40,000 commission. And the insurance company is left with $60,000. The insurance company doesn't care. It's going to take the $60,000 or the $90,000. It's going to go put that to work for the policy owner. And so when you're starting with 50% more cash, that's 50% more that is going to go to work for the policy owner. So again, there's three parties in that transaction. You can't leave out the fact, what does the insurance company do? They put money to work, whatever money they get. You want to give them 100 grand, they'll put it 100 grand. If they have 60,000 left over or 90,000 left over, or let's just say zero left over, if somebody does 100% base and they pay 100% to the agent, well, then the next year they're going to get their money and they're going to put that to work. So really, it's just how much money does that insurance company have to go put to work on behalf of the user?
Yeah, I'm with you. And it really comes down from the user's perspective, transparency and just understanding what is and is not possible. And my advice to anyone that's working with one or multiple agents is just follow the money, right? See what the numbers look like. Yeah, simple as that. And see also, when I say follow the money, what corporations are doing, because the cash value is an asset on the balance sheet. They're not taking a big hit up front, and they want the ability to continue to fund that policy for a long time if that's their goal. Like if they're setting up a policy for an executive where they fund it until he or she is 65 or something like that. But my point is, people are going to believe what they can see, not just what they hear. And if you see something that looks off, I would just ask for a second opinion, just like you would with any other product or service where you're spending a lot of money. That's exactly what I would do and what I would recommend. Last question for you here. In your journey with cash value life insurance, how you've set your policies up, how you've used them and such, anything that you do differently, if you could rewind the clock?
Of course. I would have started 30 years ago when I sold my first company, because like I said, I've already done the math on it. Everybody has two regrets when they start doing this, and they understand it, is that they didn't start earlier and they didn't start with a large enough policy. At the end of the day, you can't really do anything about starting earlier. I can't go back in time. So all I would say is that if you write about this, if you understand it, I'll say that, when you go online and you listen to all the gurus and the naysayers and the pro, the cons, and so on, they talk, it's complicated. I understand the complication portion of it. This is the easiest thing in the world. You put money in, it's guaranteed to go up every single day. You're not going to wake up one morning and the stock's down 80% or 50%, or there's a war that broke out. So it goes up every single day. It's guaranteed. It works exactly as it's described. It's a contractual agreement. So again, I would say get started. Again, you never know until you actually do it. You can read as many books on hitting a baseball as you want. Until you actually get on that mound and start swinging, you'll never be able to hit that baseball. So I would just say get started as soon as you can. And then as far as the second regret, I started two policies with, I would say, pretty decent premium at the beginning. And I learned pretty quickly that I probably didn't start with a big enough policy. So I came back. I'm up to a little over half a dozen at this point. I pay 200% of my annual income into premium, which some people say, how's that even possible? And that's because I have liquidity events. So, I'll borrow against it. For the first time ever, I did a little bit of premium financing where I used a loan on one of my policies to pay the full premium on another one of my policies. It's a 10-pay, so I want to get it fully funded. But I do have some expected liquidity events coming in the future. So as soon as that happens, I'll repay the loans, watch 10,000 of Steve's videos because he goes into complete detail of everything that, the policy, how the policy works, how loan repayments work. And my expectation and my experience, I should say so far, is that it works exactly as described. You have to understand it, but there's no surprises. There's nothing complicated about this. You put the money in, it grows, you take it out, you use it for whatever you want, and then you pay it back how and if you want.
Yeah, I like to call it a peace of mind product
Yeah.
because in many ways it is, if it's set up to give you peace of mind, meaning set up properly. Well, this has been absolutely fantastic. Just in closing, yeah, anything that you wanted to ask me or anything else that you wanted to mention about your group or anything at all, my friend?
Sure. If anybody wants to join the group, it's facebook.com/IBC users. You can go and just search Facebook on it. Like I said, I think, well, we're by far the largest users group. And again, to be clear, I don't sell anything. I have no horse in this race. People can do whatever it is that they want to do. All I will say is that don't listen to the financial infotainers out there. They don't understand the value of cash value life insurance. Nobody ever went broke because they had too much capital. The problem with most folks today, from a financial perspective, is that they don't have capital. They don't build their own capital. So they borrow, and borrowing is fantastic. And they leverage, and leveraging is fantastic as long as it works for you. But the moment that the market turns against you, or the real estate market turns against you, if you have leverage, leverage is great when it's going up, and it is disastrous when it comes down. So, average returns are not actual returns. I think the stock market, put it in the S&P. And by the way, I got plenty of money in the S&P and index funds and things like that. But, they talk about 10% returns. I think the S&P has only returned 10% like 3 or 4 times in its history. So it's either 25% or it's minus 20%, or it's, something like that. So, when things happen, and who knows, I mean, we were in the greatest bull market run up in history. The Fed's been pumping trillions of dollars into the market, blowing up every asset bubble that it can think of. So who knows how long it can last, but if and when there is a market downturn, that's when you find the real opportunities. And those who have access to capital, immediate liquid access, that don't have to beg for permission from a bank or a third party in order to get access to it, that's where I'll say the real money is made. So, I would just say if you're interested, feel free to join the group. I answer as many questions as I can. So I love talking about this stuff. And you can ask the group. You can, once you join, you're welcome to reach out to me directly. I'm happy to talk to anybody. And again, I'm pretty open and forward and direct. I'll tell you what I think, whether you like it or not. And this seems to be working well. So I think just what I would say is, again, don't listen to naysayers. Do your own research. Talk to people who are actually doing it, and then decide if this is right for you.
Yeah, great advice. We included a link of the group in the description below as well. Well, Max, this has been absolutely fantastic. Thank you so much for your time. I sincerely appreciate it. And until next time, my friend, we'll have to do one again in the future.
Well, thank you, Steve. I'll say one other thing. Understand, a whole life policy is something you should have for your whole life. So your agent relationship should be something that you think you can have for your whole life. And Steve, I appreciate you. We've gone back and forth on some personal issues and things like that. You've always been there. Great advice. So, make sure that whoever you do decide to go with, you feel comfortable that you are going to have that relationship for potentially your whole life.
Thank you very much. I appreciate that. Have a great day. We'll talk to you soon. Thank you.